What's up, you guys? Welcome to the video. My name is Brandon, and in today's video we're going to be talking about how to invest going into a recession. Hopefully this is a really timely video as we do creep closer and closer to this next recession that everybody's talking about. In this video we'll talk about a few options that you have on how you can actually profit during a recession. Not saying that those are options that I'd actually personally recommend, but we will take a look at how you can profit during a down market, and then I'll share with you guys my personal strategy, like what I'm going to be doing from this point going forward. And we'll start this video off by just taking a quick look here. For anybody that's not familiar with the business cycle, this is a chart that shows basically the four main phases of a typical cycle. This is typically the pattern that the markets will follow over the course of a number of years. We have our peak. Let's start with that. This is where the economy is, of course, functioning very well. GDP is growing. We do see inflation typically rising, but this is just where companies are performing well. It's often reflected in the stock market. Everything's good. Now, following that, we have a period called our contraction period, and this is where the economy starts to slow down. Not necessarily saying that things are all out terrible, but we do see companies, their numbers start slowing down on their reports. Investors start selling out of their stocks. We start to see the stock market fall a bit. Then we have the trough. And of course, guys, you may hear different terminology for this, but this is, let's just go with this for now. This is basically the bottom of a cycle. Investors are out of the market. Everything sucks. The economy's in shambles. Followed by, we have our recovery period and then our expansion. So this is where the market will pick back up. Technically, we'd have our recovery period first, and then we'd lead into an expansion where the market starts to push back on. And then we repeat this cycle all over again. Now, where do we stand today? Well, taking a look here at the S&P 500, or the stock market, let's call it. The stock market very closely mimics the business cycle. They follow a very similar pattern, and we could just say, for the likes of this video, that we saw our previous peak back in 2007. We hit a bottom, of course, after the financial crisis, the credit crisis. We bottomed out in 2009, and we've been on this long, extended recovery or expansion period since. Now, 10 years into this bull run, unfortunately, sooner or later, it has to come to an end. We will be entering into recession. Now, nobody knows when that is or when that's going to happen. And if you find somebody that thinks they know exactly when the recession is going to hit, whether that be 2020, whether that be 2021, or whatever their prediction is, tell them to hit the road. Even economists whose sole jobs are to go out and monitor the trends and kind of crunch the numbers and figure these things out, even they struggle with it. So nobody knows for certain. But one thing we can say, and this is kind of cheeky to say, but every day that passes by, we are technically one day closer to that next recession. So it's gonna come. Now, as you guys know, I am a long-term investor, okay? I do believe in the buy and hold strategy. I want to be invested in the markets, and I'm not one to go out and try and time the markets. I believe that investing money on a regular basis, so if you're dollar cost averaging and putting money away on a monthly basis, on a weekly basis, I personally do believe that you're better off investing through these valleys and through these dips rather than trying to predict when the crash is going to come, selling out of your investments, and then rebuying in back at the bottoms. I know how easy that does sound in theory, but in practice, it's a little bit harder than it sounds. That being said, that is just the strategy that I follow, but coming into this next recession, you absolutely have options on how you can profit as stocks are going down. So we'll touch briefly on a couple options, and then we'll put a little more focus into what I'm actually doing. But the first option that you have, of course, is to short a stock or to short the market if you believe that the market's going to be going down. And essentially what you're doing here, for anyone that doesn't know what shorting a stock is, on a very base level, you're basically borrowing shares of a specific stock, whatever the stock may be. Essentially, you're borrowing these shares. You're hoping that the share price drops down so that you can rebuy back those shares in order to repay or, oh God. return the shares that you borrowed and make a profit on that spread. It's pretty much as simple as that. Now, this is something that I probably wouldn't ever recommend to especially a beginner investor. I've actually never shorted a stock myself. I much prefer using a put option, which we'll talk about in a second. But when you're shorting stocks, in theory, your risk is unlimited. Really, there's unlimited risk potential when you short a stock. If you short a stock and that stock continues to climb, it keeps going up and up and up. It's a 5%, 10%, 100%, 1,000%. In theory, that stock could keep climbing and climbing and climbing. And again, you borrowed those shares. So at some point, you're gonna have to buy those shares back to repay the shares that you borrowed. So like I said, I personally would much rather use a put option. And a put option is the second option that you have to profit during a recession or during a down market. And this is very similar to shorting a stock. You're still hoping for the same outcome. You're still hoping for the share prices to come down, but with a put option, your losses are going to be capped out at the premium that you're paying. And basically with a put option, which by the way, if you guys are interested in me doing a video on puts, maybe calls, and shorting a stock, because I don't think I've done a video at all on my channel on those, leave a comment down below. I'll see how much interest there is for a video like that. But basically with a put option, you're basically entering into an agreement with somebody else, with another investor, that gives you the right to sell a specific stock at a specific price at some point down the road. So take the company Apple, for example, or Coca-Cola. Let's say Apple, for this example, at $100 per share. These of course aren't accurate numbers. If the share price drops down to $60, $70, $80, you have the right, you can exercise your right to sell those stocks at $100 per share. You'd be making money off of the spread. I feel like my hands are going crazy here. But yeah, that's basically the gist of a put option. I can do a much more detailed video on that if you guys are interested. But the third and probably the easiest option for anybody out there is to utilize inverse ETFs. So if you buy an inverse ETF, as the name implies, they basically perform the opposite of how the index performs. Let's say you bought an inverse ETF on the S&P 500 or the Dow. If the Dow was up 2% on the day, the inverse ETF would be down 2% on the day. So if you're certain that the markets are going to be going down, I say certain, if you know that the markets are going to be going down over the next month, over the next 3 months, for example, using an inverse ETF could be a very good option to profit during that recession or during the market downturn. Now, like I said, I wouldn't recommend any of these options to any of you guys out there, especially beginner investors. I know it's tempting to want to make money during a down market, but essentially, if you ask me, in my opinion, if you're utilizing these options that we talked about, you're basically gambling. You're more or less speculating on the performance of the market rather than investing. So now I'll share with you guys what I'm personally doing, kind of in the eyes of a long-term investor, because I am making some kind of shifts, some tactical shifts in my portfolio. As I touched on earlier, I do believe in the buy and hold strategy. I want to stay invested. However, I am taking a slightly more defensive stance with my portfolio. And whether you guys agree with this or not, you don't have to. Feel free to let me know down below. But I'm going to be adding some bonds to my portfolio just with the expectation that we have this recession looming. And I guess I could say in the next couple of years, I think it's fair to expect that we'll enter into a recession. Now, you could make the argument, and rightfully so, that like, what does a 23-year-old like myself need to be holding bonds for, right? Bonds are stupid, bonds are for old people. I totally agree. For somebody my age, for a younger person, I don't think bonds are necessary, but it is the choice that I make. When I just look out there for the types of investments out there, I'm actually happy to add some bonds to my portfolio. As we have been seeing recently, as we should know, interest rates have started to creep back up. Of course, the yields of the bonds are very closely tied to these interest rates. The performance of bonds went from pretty much being crap last year, and actually a little bit before last year, to now, I'm looking at some of these bond ETFs, which is my preferred method of investing in fixed income. Yeah, I'm actually liking what I'm seeing, guys. This is an option right here. It's probably up on the screen, ticker BLV. It's actually a US option for any of my US viewers out there. It's the Vanguard long-term bond ETF. This ETF, as of filming this video, is currently yielding just shy of 4%. Looking at the past performance, this fund has been around since 2007. It's achieved an average rate of return of 6.2%. So that's just an example. Hypothetically speaking, I know nobody ever really wants to think about this, but you kind of have to sometimes. Let's assume that a year from now or 2 years from now, the stock market is down 30%, 35%. Okay, we've entered into a recession and equities have totally sold off. Now, if my portfolio was 100% weighted to equities, which I'm sure a lot of you viewers are, your viewers' portfolios are, a portfolio like that is basically going to take the full grunt of that equity hit. Whereas if leading up to this recession, which we believe will be coming soon, we start to take profits, we start to cycle some money into a bond like this. I'm not talking like a huge chunk of my portfolio, but just a decent sized chunk in bonds. Maybe a portfolio that was a little more balanced like this would be only down 20% or 15% in the best case scenario. And if that were the case, better yet, then what I'd do is I'd take the money that I'd kind of stashed in bonds, and then I'd start picking up shares. If we're in the heart of a bear market and shares are down 20, 30, 40%, I'd then take that money and start scooping up shares and hope to kind of ride out the recovery. Another option, of course, if you're not a fan of fixed income and you don't want to hold bonds for whatever reason, is just simply hold that money in cash. Just raise the cash position in your overall portfolio. And that way it'll basically serve the same purpose. And that way, when the market does go down, you do have money to kind of redeploy when things go on sale. Personally speaking, I'd rather have my money invested in a fixed income ETF. Like I said, with the yields now creeping up to about 4% on the example we looked at, I'd rather pull in a 4% stream of income versus having that money strictly in cash. But that really is up to you. They both serve a very, very similar purpose. If you're watching this video and you're a little bit older, maybe you're in your late 30s, maybe 40s or 50s or older, and you're not already holding bonds, I would say maybe put some consideration into it. And obviously, the older that you are, the heavier your portfolio would be weighted to bonds, because not only are you going to be pulling in income from these ETFs or however you decide to invest in a bond, when the market does start pulling back, at least if history has told us anything, bonds do typically hold up fairly well. They almost work opposite of each other. That's not always the case, but typically they do hold up better than the stock market. So they are very important in a portfolio. Like I said, I don't think that they're necessary for a younger person like myself, but with just taking a look at the current yields that are out there, I'm happy to add that to my portfolio, and that's kind of the strategy that I'm implementing starting now and kind of going to be rolling that out through the remainder of 2019. But that's basically my thoughts and strategies that I'm going to be doing. Like I said, there are the other options on how to actually profit during a recession. Not that I would suggest those. Maybe you can give them a try with some smaller amounts of money. But that's it for the video, guys. Hopefully that did kind of give you some light into the way I'm doing things. I'm actually going to be, I guess depending when you're watching this video, I'm going to be adding the bonds to my portfolio tomorrow when I get into the office. So if you're interested in seeing like the exact bonds that I decide to go out and buy, I am going to be adding to a couple stocks too. You can check out our membership group. It's that first link down below. If you guys enjoyed the video, feel free to give it a like and let me know your thoughts down in the comment sections below, whether you think this is a good idea, a bad idea. Like I said, this is just what I'm doing. That by no means means that it's the only way to do things. That's just the strategy, the route that I'm taking. If you're not already subscribed to the channel, I post a video every Monday, so subscribe. And as always, guys, I thank you for watching. I hope you enjoyed, and I'll see you in the next video.